Hey folks, it's Alex Blencarn. I'm back at the kitchen table. Today I wanted to talk to you guys about how to analyze an investment property in the city of Peterborough, Ontario. So before we begin, let's talk about some key practices when you're purchasing an investment property. So it's definitely important to know your market rents, to choose a good tenant, and to buy a property in a good neighborhood in Peterborough that is going to appreciate. Another good idea is to set some goals for your investment property. So the goal for this hypothetical situation in this investment property, we are looking for a property that is going to give us a return on our money that is at least comparable to other investments such as the stock market or GICs. So we're looking for something north of a 4% or 5% return on our money. We're also looking for a cash flow that is at least around $300. So the hypothetical subject property is going to be a 4-bedroom duplex in the Old West End in Peterborough, and it's going to have a list price of $550,000, so $550,000 for that list price. So let's say, for example, we did purchase this property at the list price. What we would be getting is a 4-bedroom duplex, so 2 units with 2 bedrooms in each unit. So for the closing costs for this property, we'd be looking at around $10,500. That would be your land transfer tax of $7,475, as well as your lawyer's fees, which can range around, $2,500 to $3,000. So let's be comfortable in budget around $10,500 or $11,000 for those closing costs. Now, when we're looking at annual growth of the property, it's safe to assume in Peterborough that you're going to get around 3, 4, 5% for your annual growth. Again, it depends on which neighborhood you're investing in. So, best neighborhoods to invest in terms of overall growth. Over the last couple of years, we've seen, the West End, we've seen the North End, and then probably Eastern Peterborough as well. Now, for this property, it is located in the central Peterborough technically, but also kind of in that Old West End. So we're going to go with probably around 4% appreciation for this property. Now let's talk about the loan details that you'll need for an investment property. So if you are not living in the property, which we're not going to do in this scenario, you'll need to put down 20% for your down payment when you're not living in the property. So you're putting down 20%. You'll need a mortgage for the other 80% of the property. Now, right now, the interest rates are kind of on the rise, but what we chose to go with for this investment property would be a 5.5% interest rate. Now, it may change depending on, which mortgage broker you're using, but in my opinion, best advice is to always use a mortgage broker, as they're going to be able to get you a lower rate sometimes than what the banks offer. And if you guys are interested, I'll link 3 mortgage brokers down below that I work with that are excellent. Finally, for the amortization, we're going to keep it at 30 years for the amortization. What this is going to do is it's going to lower our monthly payment by the most amount possible by increasing that amortization. So what we're trying to do is eliminate the amount of expenses that we have so that we can further cash flow on this property. So go with 30 years for your amortization. Okay, now we're going to talk about gross rental income. So for a 2-bedroom unit in the city of Peterborough, you're really looking at around $1,100 to up to $2,200 for your rent for the month. Now, it depends on your finish level and, location, access to amenities, all kinds of things. So for this general property, we're going to go with $1,650 for the 2-bedroom rental unit. So $1,650 times 2 will give us a monthly rental income of $3,300. Now let's break down the expenses. So for the expenses, we're looking at property taxes as our first one. So property taxes for this type of property in this location, you're really looking around $3,500 to $4,000 annually. So we're going to pick a middle number of $3,700 for our property taxes. Now for insurance, it's typically going to run you around $100 to $200. So again, we're going to pick something in the middle at $150 per month for this hypothetical rental property. Now, the next expense you need to budget for is repairs and maintenance. This inevitably things will break in the rental property, so it's always best to budget for those things ahead of time. Now, typically you can expect around 5 to 10% to budget for repairs and maintenance. Now, it depends on your tenants. For example, if you're renting to maybe some first or second year students that seem to be a little bit irresponsible and they're going to be having parties all the time, you might want to budget 10%. But in this case, we're going to, again, stick with something in the middle and go with 7% for our repairs and maintenance. The next thing is vacancy. Now, Peterborough actually has one of the lowest vacancies in Ontario. I believe it's actually under 1% right now. But typically, you're going to want to set it for around 5%. So that's what we did in this case. Now, it won't be hard to find tenants, especially right now in September 2022. There are tons and tons of tenants looking for properties. But let's just keep it as 5% just to be generous and allow for maybe any potential changes in the near future with vacancies. Now, for those that don't know, the vacancy rate is the cost of a property sitting empty due to tenant turnover. Next, we'll talk about capital expenditure. This is budgeting for big things such as new appliances, maybe a new roof, maybe some new siding. For this, we're going to go with 5% yet again. So we'll take 5% of our monthly income and put it towards our capital expenditure. So when we do need a new roof, we've got some money stored up in order to make that addition to the property. Now we're going to talk about management fees. So in this case, in the ideal world, as a landlord buying an investment property in Peterborough, right now, we do not want to manage that property. So we're going to budget around 10% for property management. Now, it depends on the property management, and rates may vary depending on the service that you get from that property manager. So feel free to shop around and choose which service works best for you. In this case, we're going to stick with around the average, which is about 10% for property management. So let's see how the results turned out. So for our monthly expenses for this property, we are looking at $3,847.27. That's our expenses. Now, if we compare that to our income, we're only making $3,300 from those 2 rental units. This means that our monthly cash flow is actually at a negative of minus $547.27. That means that we're losing $547.27 every month with this property. Now, if we look at the cash on cash return, we're at minus 5.45%. That means that our money that we're investing into this property, we're losing around 5.5% every single year. So is this a good investment? No. Remember, we wanted around $300 to $400 of cash flow, positive cash flow per month on this investment, and we wanted a return of at least more than what we can get in the stock market or what we can get with GIC. So that's probably north of that 5 to 6%, and we're at minus 5.5% for our cash on cash return. So I would not recommend it investing in this property if you're looking for cash on cash return and cash flow. So what's really interesting is if you look at this chart here, you can look at the projected outcome of the property after 5 years and what that property may be worth with a 4% growth rate. Now, if you look at what you would potentially make after you sold in 5 years, it's around $116,000 of profit when you're looking at that 4% growth rate. Now, is that a good investment? Well, you're really losing money every single month because you're in a negative cash flow. So I wouldn't recommend investing in this piece of property if your goals are for cash flow. Even if your goals are for appreciation, you're still losing money every single month. So it's probably not the best move because oftentimes people want to invest in real estate so that they can create passive income. And in this case, you're losing around $500 every single month. What's important to remember with investment properties is that you can tweak the numbers to achieve your goals. So let's say, for example, we shrunk the vacancy down to a realistic number of around 2%, and we eliminated that property management fee. So we were going to manage the property ourselves. Now we're still sticking with that $3,300 a month income, and we're still sticking with that $550 purchase price. How do the numbers look then? Well, now we're at minus $118 a month for our cash flow, so a little bit better. And our cash on cash return is just under minus 2%. So still a little bit better, not great, but a little bit better compared to last time. And in terms of appreciation, now if we sold after 5 years, we'd expect maybe around $144,000 of profit if we sold after those 5 years. So how would we make this property work? Well, let's say, for example, we purchased it at $450,000. So purchase price is $450,000, and we put down 30%. So we've got a 70% loan to value. We stuck with that $3,300 income, and we stuck with vacancy at 2%, and we eliminated property management. So we purchased for a lower amount, and we put more of our money into the deal. How is that going to affect cash flow, cash on cash return, and our profit when we sell the property? Let's break it down. So our cash flow for the property would be $589 a month with a 4.86% cash on cash return. So we met our cash flow goal. In fact, we actually went above it at $589 a month. That's pretty good cash flow for this property. Now our cash on cash return, it's still under that 5%, but we could work with that if we're getting around $500 a month of cash flow. That's a huge bonus. That is a bunch of extra income for our checkbook. Now here's a quick scenario for you. Let's say we did want to go with that property management company. So we upped that to 10% with the same scenario as last time. Let's say we really didn't want to have to manage our own properties because we were hoping to create passive income. How would that affect the numbers? Well, now we've got a cash on cash return of 2.14%, and we're making around $259 a month in cash flow. So it changes things a little bit. We're not getting as good return, and we're certainly not getting as much cash flow, but we take the risk of having to manage that property by ourselves and the time required to manage that property, and we take that away. So it's technically now passive income. So it's up to you guys which route you want to go. If you did want to use a property manager, you can see the effect of that on the property. Or if you wanted to manage it yourself. Maybe you manage it yourself for a couple of years, you build your portfolio, and then you go ahead with property management to take the workload off. Alrighty guys, that's all for me. I hope you guys really liked that video, and I hope that helped analyze an investment property in Peterborough, Ontario. Go ahead and reach out if you're interested in investing in Peterborough or if you have any questions at all. I'm Alex Blenkarn. This is The Kitchen Table. I hope you guys enjoyed that. Until next time, take care.